The government has launched the 95% mortgage guarantee scheme, but how good is it? Will it be of any benefit to you as first time buyers? I'll be looking in this presentation some facts about this particular product and whether there is a better alternative to this one. I've got a comparison as well. So stay until the end of the video and see if you find this helpful.
So in this video, I'll be taking you through the government-backed 95% mortgage guarantee scheme, some facts about it, and I'll do a little comparison with, if there is a better alternative. So I'll do a little comparison, and it's down to you to decide whether it's right for you or not. But I'm not a mortgage advisor, so it's important to make it clear that you must consult your mortgage advisor before you decide what to do. So let's get into the presentation. The 95% mortgage-backed scheme, government-backed scheme, which is designed to help first-time home buyers, that is now out in the market from this April, and let's look at some facts about this. So the mortgage is only available for properties where the person intends to live in, so it shouldn't be a second home or a buy-to-let. So very suitable for first-time buyers. And the mortgage is only available on a repayment mortgage. So if you are aware, there are two kinds of mortgages, especially if you're an investor, then of course, most of the investors are into interest only, but this particular product is only available on a repayment mortgage. It is not available on a company or a corporate purchase, so it is only available as an individual purchase. So when you say individual, it doesn't have to be one person, it could be a joint purchase as well. So if it's a husband and wife, that's also considered as individual purchase. So basically, the important thing is that it shouldn't be on a limited company purchase. The property needs to be 600,000 or under, and it should be a UK property, pretty clear there. The application deadline for this 95% mortgage is December next year, 2022. So it's opened from this April until 2022, but I think they are open to extend it if necessary, but right now the application is until December 2022. The mortgage guarantee valid for 7 years. So what it means is, I know the term here used is mortgage guarantee scheme. So it's not guaranteeing a mortgage, it's actually, what it's saying is the lender, because the lender is providing the 95% loan, which is a high risk product, and if the borrower defaults, then it's the government who's guaranteeing the loss to the lender. So it's nothing to do with the borrower. If you are the mortgage holder, then it's nothing to do with you, and this is more for the lender. Okay, and the government is guaranteeing for 7 years from the time the mortgage actually started. It is applicable to new and existing properties. Okay, so whereas some schemes before, such as the Help to Buy, was only available on new properties only, but this one is available for both existing as well as new properties. However, some lenders have chosen not to include new properties on this one. So this is down to a specific lender whether they want to include new properties on this one or not. The lender is also, they should offer the product for a 5-year fixed as well. Normally, mortgages, they are available on a 1 year, 2 year fixed, 3 years, and 5 years. So, but with this, if the lender is offering you this particular product, then they should offer you a 5-year fixed term as well. Okay, not all lenders are offering this product, because this is something where the lender needs to apply to the government and or buy that scheme from the government. So maybe this is not suitable for all kinds of lenders. So just you just want to be clear that not every lender is offering this, but I think the numbers are increasing on that one. Also, because it's a high loan to value, 95%. So having an excellent credit score is to your advantage. I think some of them are requiring you to have excellent. Even good is not good enough. It has to be excellent credit score. But again, it might vary slightly from lender to lender. Of course, you have to also pass the income to loan to income ratio, which is sort of your affordability. Normally, your gross income times 5 is how much you can borrow. Okay, but with the high loan to value products, some lenders are actually capping it at 4.5 times your income rather than 5 times. Okay, and I have an example of this one on the next couple of slides there. Also, lenders, they choose their own rates. So, but the going rate on this one is 3.99, almost 4% for a 5-year fixed, and about 3% for a 2-year fixed, on an average, but it might change slightly from lender to lender. So the 95% loan to value is a very high loan. It's a very risky product, so it may not be suitable for everybody out there. So is there a better alternative? Nationwide increases maximum LTI, loan to income ratio, to 5.5 for the first time buyers. Now what that means is, like I said earlier on the slide, where you've got the affordability test, the 4.5 times your annual income, but Nationwide has been the first mortgage provider who is actually lending 5.5 times the annual income for the first time buyers, which is a great news, I think. Now, what I'm doing here in this next slide is comparing the two scenarios here. So you got one, which is the 90% loan to value offered by Nationwide at 5.5 times your income. Okay, and then you got the government-backed mortgage guarantee scheme, which is at 95% loan to value, but some lenders are capping that at 4.5 times your income. So I'm looking at a little scenario here where you got your purchase price, the property price is 200,000, assuming that your gross annual income, whether it's joint or sole, is 33,000. Okay, so the mortgage needed here would be 180,000, which is the 90% of your 200,000, and over here it's 190,000. Okay, because you've got 95% of 200,000 is 190,000. So that's how much mortgage you need to buy a property worth that much. Now, when you put into consideration the loan to income ratio, which means your income, 33,000 times 5.5 is 181,500. Okay, so that's how much you can afford. And the mortgage needed is 180,000. So which means you perfectly qualify down here. But let's look at the next scenario here, where 4.5 times your income is 148,500, which is well below the mortgage needed, which is 190,000. So your affordability test here, doesn't actually meet. So here, but if you still wanted to purchase the property, then of course, if you've got the deposit, then the deposit required here would be 51,500, whereas here it's only 18,500. But then if you haven't got that deposit, let's say you only got 20,000 deposit, then you're not able to afford the product, the mortgage, in this scenario here at a 95% LTV. And that's a difference. If you look at the difference, that's a difference of £33,000. That's how much more money you need to be able to afford the 95% LTV. So although it might sound like, wow, 95%, you can borrow up to 95%, but it may not, again, suit every buyer. Also, another really important thing here is that 90% mortgage is nearly 1% lower than the 95% mortgage, which means the interest rate is nearly 1% lower, which makes a big difference on your monthly payment. So overall, it seems like the 90% LTV, which is at a 5.5 income, is more suitable than the mortgage guarantee scheme, the 95% LTV, which is backed by the government. So this is just a scenario. This is just an example of what I'm looking at, and it may not be relevant to every buyer, but it just gives you some idea on what you're looking at, what you should be looking at, and whether that is going to be right for you. So I hope that was helpful. Now, if this is the first time you're on the channel, my name is Pragati, and I'm the author of the book Financial Freedom for Immigrants, which is about helping new investors and immigrants to the UK get on the property ladder as early as possible and start building wealth and passive income. If you found that video helpful, please do like and subscribe my channel, and I'll be coming back with you more relevant topics like this in future.